Tracking the daily spot price of uranium right now is, it's a lot like watching a heart rate monitor.
Right.
You know, it gives you the market's current emotional pulse, but it tells you absolutely nothing about the patient's actual long-term health.
No, it really doesn't.
Because this week, the headline price dropped. And a lot of retail investors are just sweating, looking at this flashing red screen. But behind the scenes, institutional giants like Goldman Sachs are quietly modeling a 2.3 billion pound structural shortfall.
Which is just a staggering disconnect. I mean, when you look at it, you have retail traders panicking over what is essentially a momentary blip, while the smart money is, they're basically backing up the truck.
Yeah.
They're preparing for a supply drought that could last decades.
Decades, right. And that is exactly why we're opening up the May 29, 2026 Uranium Unleashed Issue number 7 report, which, by the way, you, our listener, brought to our attention.
Great find, honestly.
Yeah, really great find. So our mission for this deep dive is to cut right through the day-to-day noise of that retail trading. We're getting into the war room today.
Exactly.
We're going to examine the macro fundamentals, the massive institutional money flows, and the geopolitical choke points that are actively dictating this global nuclear energy renaissance.
Because if you only look at the ticker tape, you're missing the tectonic plates shifting underneath. I mean, the real wealth generation in commodities, it doesn't come from day trading the spot price.
Right.
It comes from understanding the structural forces at play well before the broader market prices them in.
Okay, let's unpack this. Because to truly understand the market's long-term health, we first have to look at that heart rate, right? The headline spot price.
Yeah, the flashing red light.
Right. And we need to break down why looking at it might actually be blinding the retail crowd right now. So the big headline this week is that the spot price closed at approximately $84.50 per pound. That's down about $2 from the $86.50 we saw earlier in the week.
Right, but wait. If you were only looking at a 5-day chart, sure, a $2 drop feels like a punch to the gut. Yeah, it hurts. It hurts. But pull back the lens. Let's look at the year-over-year data. Back in May 2025, the spot price was sitting around $80.
Okay.
So despite this week's pullback, the asset class is still up about 6% year over year. This isn't a trend break. It's just, the market taking a breather.
But the report highlights something even more fundamental about how uranium actually trades, which I found fascinating. The spot market, where this 84.50 number comes from, it's basically a sideshow.
Oh, completely.
Like, the vast majority of physical uranium moving around the globe is locked up in long-term contracts.
If we connect this to the bigger picture, the underlying fundamentals of the uranium market remain entirely decoupled from this $2 dip.
Interesting.
Yeah, because the spot market is incredibly thin. It's illiquid. It's mostly utilities buying a few pounds just to, balance their books at the last minute. Or traders flipping paper.
Just paper trading.
Exactly. The heavy lifting, the actual baseload fuel supply, that's negotiated in multi-year bilateral contracts between the miners and the utilities. And those prices are negotiated based on future scarcity, not today's spot price.
Okay, let me stop you there. Because if the spot price is mostly just an emotional signal for a very thin market,
right,
and all the real volume is locked in long-term contracts, is tracking the spot price just a massive distraction for retail investors?
Yes, absolutely.
Are everyday investors essentially staring at this flashing red light while institutions quietly engineer the real moves behind the scenes?
That's exactly the trap. Retail over-indexes on the spot price because it's highly visible. It updates frequently.
It's right there on the screen.
Right, but the institutional money isn't sweating a $2 dip. They are looking at the foundational, physical realities of pulling heavy metal out of the ground. And this week, we had 3 massive structural stories that show exactly what Wall Street is actually paying attention to.
Well, let's get into the actual physical reality then, starting with NexGen Energy.
Yeah, a huge one.
Right. Their Rook I mine down in Saskatchewan, which sits on the massive Arrow deposit. It just crossed the Rubicon.
Big time.
They announced their final investment decision, and they officially secured their construction license from the Canadian Nuclear Safety Commission. Shovels are literally going in the ground this summer.
You really cannot overstate the importance of a final investment decision in the mining sector.
Because it means the money is locked in, right?
Exactly. It means the capital is fully committed. The point of no return is crossed. We are talking about one of the highest grade, undeveloped uranium ore bodies on the planet, and it's in a top-tier jurisdiction.
Yeah.
But look at the math on their timeline. They're breaking ground right now, but they are targeting first production around 2030.
Wait, 2030? That's 4 years away.
4 years. at minimum.
Wow.
Because you don't just, dig a hole. You have to build massive infrastructure. You have to literally freeze the groundwater in Saskatchewan to sink the shafts safely.
Freeze the groundwater. That sounds incredibly complex.
It is. And on top of that, you have to navigate incredibly strict nuclear regulatory hurdles. It takes half a decade to bring even the best assets online.
Okay, now put yourself in the shoes of a utility manager running a fleet of nuclear reactors.
Yeah, you're stressing out.
If you're looking at NexGen's 2030 timeline, you are sweating. You have power plants burning fuel today.
Yes.
You can't wait 4 years for the cavalry to arrive.
Right.
You need supply now. And I think that panic leads us directly into our second major story, what Cameco just pulled off.
Right. So back in March of 2026, Cameco signed an absolute monster of a deal with India's Department of Atomic Energy.
Oh, this was wild to read.
22 million pounds of uranium over 9 years? That is a $2.6 billion commitment.
And India isn't just buying that for fun.
No.
They are rapidly expanding their nuclear fleet to baseload their economic growth. They recognize that global supply is incredibly tight. So Cameco locking in that contract, that sends a massive signal.
It really does.
Nation-states are willing to pay a heavy premium to secure whatever existing reliable supply they can get their hands on today.
And Cameco can actually deliver on it now, because as of May 27, the flooding disruption at their McArthur River mine is officially resolved.
Oh, that's great news for them.
Right, they are back to full production. So you have new supply, like NexGen, crawling toward 2030, and existing supply being aggressively swallowed up by nation-states like India.
That alone is a potent mix. But the third pillar of this bull case, it might be the biggest macroeconomic signal of the entire year.
Easily.
On May 16th, Goldman Sachs officially added SMRs, which are small modular reactors, to their long-term uranium demand model for the very first time.
This is a total paradigm shift for the asset class. Goldman is projecting 46 gigawatts of SMR deployment by 2045. Now, mechanically, why does this matter? SMRs are completely different beasts than traditional reactors.
Right, because instead of spending 10 years custom building a massive, sprawling concrete dome on site, SMRs are essentially prefabricated. Like, you build the components in a factory, you put them on a truck, and assemble them on site. It's meant to be way faster and cheaper.
Exactly, that's the pitch. But the trade-off is the fuel density. Many of these SMR designs require high-assay, low-enriched uranium, or at the very least, they require massive initial core loads of fuel just to get the thing started.
So they are incredibly fuel hungry right out of the gate.
Yes. So Goldman modeling 46 gigawatts of this tech translates to an extra 62 million pounds of newly uncovered uranium demand. That is a 17% upside to their previous estimates.
That's a massive revision.
It is. And when they map that new demand against the incredibly slow 4-year supply pipelines like NexGen we just talked about, Goldman predicts a cumulative supply deficit of 2.3 billion pounds by 2045.
2.3 billion pounds. That is a staggering mathematical shortfall.
It's hard to even wrap your head around.
But what strikes me is the messenger here. It's Goldman Sachs. Goldman adding SMRs to their model is like a major stock index, including a new tech sector for the very first time.
That's a great way to put it.
Right. It forces every single institutional portfolio manager who thought SMRs were just science fiction or a novelty to suddenly rewrite their risk models, doesn't it?
It legitimizes the entire narrative. Wall Street treats Goldman's commodity desks as the gold standard. When a Tier 1 investment bank slaps a 2.3 billion pound deficit on the dashboard, it is a flashing green light for institutional capital to enter the space.
Okay, so if institutions are waking up to this 2.3 billion pound deficit, how is that money reacting right now compared to the retail investor who is just stressing over the $2 drop in spot price?
Well, this is where the data gets really interesting.
Yeah, your report includes a multi-platform sentiment heat map to track this exact divergence. It scores sentiment across news, YouTube, Substack, X, Reddit, and institutional research on a scale from -10 to +10.
And the data reveals some incredible psychological divides. Take NexGen, for example.
Sure.
The heat map scores them at a +9 overall.
Very high.
Yeah, retail's at a +9, and institutional research is at a +8. It's almost unprecedented to see a perfect convergence like that.
Yeah.
Both sides of the market are entirely aligned on the execution of that project.
Makes sense with the shovels going in the ground.
Right. We see something similar with Cameco. It's a +7 overall, with institutional sentiment at a +8, as Wall Street digests the sheer magnitude of that $2.6 billion Indian contract.
But then we look at the geopolitical wildcards. We look at Niger.
Good day.
And the heat map just fractures completely. Retail sentiment for Niger is sitting at a -7, but institutional sentiment is buried at a -9.
Yeah.
That is a stark 2-point gap on the absolute most pessimistic end of the scale.
What's fascinating here is what that 2-point gap actually represents in the real world. It is the speed of pricing in reality.
Okay, what do you mean by that?
Institutional money is pricing in a total prolonged supply collapse out of West Africa much faster and much harder than the retail crowd.
So are retail investors just holding on to false hope in West Africa? Like they see the headlines, but they assume the dust will settle, deals will be struck, and the uranium will eventually just flow again. Or is institutional money historically just faster at pricing in these geopolitical dominoes?
Institutions do not trade on hope.
Right.
They trade on probabilities.
Right.
They take the emotion completely out of the equation and look at the physical mechanics of the supply chain. To understand exactly why Wall Street slapped a -9 on Niger, we have to look at the jurisdiction risk map in the report.
Let's dig into that, because the report breaks down the 90-day disruption probabilities for all the major producing regions. And Niger is glowing red with a 75% disruption probability.
Yeah, it's an active situation.
The facts on the ground are stark. In May 2026, Orano, which is the massive French nuclear giant, had their 58-year Arlit concession officially canceled by the government.
Let's just pause on that for a second. 58 years.
It's crazy.
That is multi-generational infrastructure and relationship capital just wiped out with a pen stroke. And it gets worse mechanically. An ICSID court, which is an international arbitration tribunal, issued an order telling Niger not to touch the stockpiled uranium.
Wow.
Meanwhile, the nationalization of the Somayar operation is still actively ongoing.
But wait, how does an international court order actually stop a sovereign country from doing what it wants with its own physical stockpile, like practically speaking?
It doesn't physically stop them from moving the barrels. They can still load them on a truck.
Right.
But it paralyzes the buyers. If an international court rules that the uranium is technically contested or stolen property under international law, Western utilities will absolutely not touch it.
Ah, the legal risk.
The compliance risk is too massive. So mechanically, that supply is trapped. It is cut off from the global market. That is why institutions see a 75% disruption probability as a mathematical certainty, not just a political opinion.
Man, that is huge. And from there, the map takes us to Kazakhstan, which is flagged as a moderate risk with a 15% disruption probability. Now, this isn't about outright nationalization like in Niger, right?
No.
It's about the government implementing new tax frameworks on Kazatomprom, the state producer. But how does a tax framework actually disrupt the physical supply of uranium?
Because mining is incredibly capital intensive. When a government aggressively changes the tax framework, they squeeze the producer's profit margins.
Okay, that makes sense.
If Kazatomprom has less free cash flow, they have less capital to drill new wells, purchase sulfuric acid, and invest in future infrastructure. It introduces financial friction. And in the commodities world, friction always translates to less future supply and a higher risk premium today.
Interesting. Okay, then we get down to the low-risk zones on the map. Namibia is sitting at an 8% low probability. Paladin Energy is facing a minor environmental impact statement legal challenge, but their operational ramp-up is otherwise moving forward nicely.
Yeah, fairly smooth over there.
And finally, we look at Canada, specifically the Athabasca Basin in Saskatchewan, sitting at a 5% low probability. The MacArthur River flood is resolved, and NexGen is breaking ground.
Yep.
Here's where it gets really interesting. Looking at these probabilities side by side, Canada is essentially the Swiss bank account of uranium right now, isn't it?
That's the perfect analogy.
It's safe, a little boring compared to emerging markets, but exactly where you want your supply coming from when West Africa gets turbulent.
The capital flight to safety is very real. When the geopolitical map lights up red like that, institutional capital runs to jurisdictions where the rule of law is predictable, where property rights are guaranteed, and the regulatory framework doesn't just change overnight.
Right.
Saskatchewan is the ultimate safe haven, and Wall Street is actively pricing a massive premium into those assets.
Given this massive flight to safety, the structural deficits from Goldman, and the long-term contracts locking up existing supply, how does this translate into actionable market intelligence for the week ahead?
Right, let's get into the plays.
The report gives us a very punchy companies to watch list. Let's go through the catalysts.
It's all about identifying execution milestones right now. So for NexGen Energy, you are watching for any PR regarding construction mobilization.
Okay.
They have the license, so any news about site preparation or contractors moving heavy equipment is the physical validation of their timeline.
Got it. And for Cameco, the immediate watch point is their Q2 guidance. Now that the India deal is locked in and the Key Lake restart is back at full operational capacity following the floods, the market wants to see those massive numbers officially baked into their forward financial guidance.
Exactly. Next on the list is Denison Mines. Their Phoenix project is utilizing in-situ recovery, or ISR, and construction is already underway.
And we should probably clarify what ISR actually is for you listening, because it's fundamentally different from what NexGen is doing. With ISR, you aren't digging a massive open pit or sinking a mild shaft.
Right. If the geology allows for it, ISR is much less invasive. You inject a chemical solution into the underground aquifer, dissolve the uranium directly in the host rock, and pump the uranium-rich solution back to the surface, almost like a water well.
Oh, wow. That sounds way more efficient.
It requires drastically less upfront capital and has a much smaller environmental footprint. For Denison, the key catalyst to watch now is the announcement of strategic partners or offtake agreements to really validate the project's economics.
And finally, Energy Fuels. They have a Q2 update coming, and they've already hit an impressive 1 million pounds of production in just 4 months. But here's the wrinkle in the report. They are expanding their processing capabilities into rare earth elements, or REs, by mid-2027.
Yeah, big pivot.
I have to push back on this strategy, actually. Does Energy Fuels pivoting into rare earth elements dilute their thesis as a pure play uranium stock? Like, if I'm an investor looking for pure exposure to a uranium bull market, isn't this a distraction? Or is it a genius hedge against the exact kind of spot price volatility we've been talking about?
This raises an important question about how companies balance core commodities versus strategic pivots, especially when trying to survive the commodity cycle.
Right.
Geologically, uranium and rare earth elements are often found in the exact same ores, like monazite sands. So processing them together makes mechanical sense.
I didn't know that.
Yeah, it's highly synergistic. But strategically, a domestic U.S. facility that can process both baseload nuclear fuel and the critical rare earths needed for advanced technology becomes an indispensable asset for national security.
Ah, I see.
Yes, it dilutes the pure-play uranium torque slightly,
Yeah.
but it massively diversifies their revenue and insulates them from the whims of the daily uranium spot price.
It's a fascinating pivot from just a pure commodity play to a strategic national asset.
Yeah.
So, pulling all of this macro data together, the report issues a sector grade for the week, and it comes in at a B+ with a clear directive to accumulate. The authors specifically argue that a dip in the spot price, when layered over incredibly strong structural fundamentals, is a setup. It's not a reason to sell. And of course, we have to explicitly state for you listening, this is market intelligence. This is not financial advice.
Definitely not financial advice. But the logic behind the B+ accumulate grade is very sound.
Yeah.
The foundation, the aggressive nation-state contracting, Goldman's 2.3 billion pound SMR demand model, the forced geographic shifting of supply to safe havens, it's objectively strengthening. Accumulating means recognizing that the underlying value of the asset is growing, even if the headline price took a brief pause this week.
So what does this all mean? Let's bring it back to the mission we started with today. We completely bypassed the emotional noise of a $2 drop in the spot price. We looked under the hood and uncovered tectonic institutional movements.
Huge movements.
We explored the mechanics of why Goldman Sachs is projecting a historic 2.3 billion pound supply deficit driven by SMRs. We broke down how international courts and nationalizations are driving a 75% supply disruption risk in Niger, and why that is forcing a massive capital premium toward the absolute safety of Canadian assets.
It's all connected.
It really is.
Yeah.
I want to thank you, the listener, for bringing this incredible market intelligence report to the table. It fundamentally changes how you look at the daily market noise. And to quote the report sign-off directly, stay critical, stay radioactive.
I love that sign-off. And I want to leave you with one final provocative thought to mull over.
Okay, let's hear it.
If Goldman Sachs is projecting a 2.3 billion pound supply deficit by 2045, and we just saw that it takes years and incredible capital to bring a Tier 1 asset like NexGen's Rook-I from a license to actual production in 2030,
Yeah.
are we looking at a permanent structural deficit that no amount of sudden Wall Street capital can fix quickly enough?
Wow. Because you can't just throw $1 billion at a geopolitical map and make a fully operational uranium mine appear overnight. It really makes you wonder if that spot price heart rate monitor is about to start beating a whole lot faster.